Jane has been a company owner for almost a year. Her firm was successful and prospered that year. Her accountant arrived at her office one day while she was at work to deliver her the financial statements that would be attached to her income tax return. She then requested her accountant to interpret the details in the report for her. The accountant began to discuss the information in the report with her. However, Jane could not grasp the financial terminology used by the accountant. What are those assets? What are those liabilities? Equity, income, expense? The discussion ended with her still not understanding the data in the report and the status of her company. As a business owner, it is important to know the different financial terms in order to comprehend the financial reports of the company and the financial matters that we may encounter and affect our company. Having a thorough understanding of this financial terminology will enable us to make sound economic decisions and enhance our day-to-day operations. That is why in this video we will talk about the elements of financial statements. The elements of financial statements are the building blocks from which financial statements are constructed. It refers to the quantitative information reported in the statement of financial position and income statement. The presentation of these elements in the statement of financial position and the income statement involves a process of classification and subclassification wherein the elements directly related to the measurement of financial position are the asset, liability, and equity, while the elements directly related to the measurement of financial performance are income and expense. Elements of financial position. Asset is present economic resource controlled by the entity as a result of past events. To further understand what really an asset is, here are the essential characteristics of an asset. First, the asset is the result of a past event. Entities normally obtain assets by purchasing or producing them, but other transactions or events may generate assets. Transactions or events expected to occur in the future do not in themselves give rise to assets. Hence, for example, an intention to purchase inventory does not of itself meet the definition of an asset. Second, the asset is controlled by the entity. An entity controls an asset if it has the present ability to direct the use of the asset and obtain the economic benefits that flow from it. It also includes the ability to prevent others from using such asset and therefore preventing others from obtaining the economic benefits from the asset. And lastly, the asset has the potential to produce economic benefits. A very important term that must be dealt with in this phrase is the word potential. This means that for the potential to exist, it does not have to be certain nor even likely that the right will produce economic benefits. According to the framework, it is only necessary that the right already exists, and that in at least one circumstance it would produce for the entity economic benefits beyond those available to other parties. These economic benefits can come in many forms, such as, for example, the right to receive cash from collections receivable, the right to receive cash from sale of inventories, the right to receive rental payments from leasing its property, and others. Let's take for an example. Jane purchased an equipment to John which she will be used for the day-to-day operations of her business. This equipment is considered as an asset as it met the three criteria. As a result of the purchase transaction, the past event, title has passed on her which enables her to access exclusive control of the future economic benefits that this equipment may provide to her business and prevent others from using it. Assets are further subdivided into two classifications: current assets and non-current assets. According to the framework, an entity shall present current and non-current assets as separate classifications in the statement of financial position. However, for some entities such as financial institutions, presentation of assets in increasing or decreasing liquidity provides information that is faithfully represented and more relevant. Current assets are companies' cash or cash equivalents and all assets that are expected to be consumed, sold, or converted into cash either in 1 year or in the operating cycle of the entity, whichever is longer. Cash and cash equivalents are considered current assets because they are an entity's most liquid asset and can be promptly used to meet its day-to-day expenses. However, this is not always the case, since in some circumstances, it is more appropriate that cash should be classified as a non-current asset. For instance, you have cash in a sinking fund that is set aside for bond payments due after 3 years. Cash should not be categorized as current in this case because the cash is restricted to settle an obligation for more than 12 months after the reporting period, meaning that cash will not be readily available in the payment of current obligations as it was subject to restrictions. Another factor to consider when determining whether an asset is current or non-current is how long the organization anticipates it to take to convert the asset into cash. As for current assets, it shall be consumed, sold, or converted into cash within a year, or within the operating cycle, whichever is longer. When we say operating cycle, it refers to the time it takes a company to buy goods, sell them, and receive cash from the sale of said goods. The best example of an asset that are realized within the normal operating cycle are inventories, because these are goods available for resale in the normal course of business in case of merchandising companies, whereas goods available as raw materials, work in process, and finished goods form part of inventories in case of manufacturing firms. Also, assets are classified as current if they are expected to realize within 12 months after the reporting period, such as non-trade receivables that are collectible 1 year from the end of the reporting period, regardless of the length of the operating cycle. Lastly, it is considered to be a current asset if the entity holds the asset primarily for the purpose of trading. When we say for the purpose of trading, these are the assets that are purchased with the intent of selling them in the near term or very soon in order to generate short-term gains or profits, such as marketable securities. Taking all of these into account, you may think of current assets as short-term assets that are necessary for a company's immediate needs, or assets that can be easily converted into cash and utilized to finance day-to-day business operations and pay for continuing operational expenditures. Non-current asset. An entity shall classify all other assets not classified as current as non-current assets. It includes property, plant and equipment, long-term investments, intangible assets, deferred tax asset, and other non-current asset. That ends the discussion about asset, one of the elements of financial position. Part 2 of this video will discuss the remaining elements of financial position, which are the liabilities and equity, as well as the elements of financial performance, income and expense, which can also be viewed on this channel. Thank you for watching.